We've got two urgent updates today, and they're not just about geopolitics or markets or bond charts. They're about you, your savings, your future buying power, how much poorer we're all going to feel in the years ahead. Because whether you realize it or not, something massive is breaking beneath the surface of the global economy, and the shockwaves are already here. America is heading into an economic storm of its own making, a trade war spiraling out of control, a tech arms race with China that's swallowing trillions, a reindustrialization project that sounds patriotic on paper, but comes with a price tag big enough to drown the entire budget. And the worst part? The US can't afford any of it. Not sustainably. Not anymore. This isn't the America of the post-WW2 boom, rich in gold, factories humming, the dollar untouchable. Today's America is built on debt. And that debt is now rising at a speed no country in history has ever survived. 25 years ago, the national debt was $6 trillion. Today it's crossed $38 trillion. That's not growth. That's an exponential disaster. Trillions created in 2008, trillions more in 2020. Every crisis solved by simply pushing more money into the system. Money that had no business existing. Money that inflated the price of everything: homes, food, energy, assets, your life. Then, in 2022, interest rates went up. And that's when the real crisis began. Not because Washington printed too much again, but because the existing debt burden was already so monstrous that even normal interest levels became catastrophic. The snowball started rolling. And now, it's not a snowball anymore. It's a boulder racing downhill. And the city below? That's the US economy. There is only one way out now. And it's a way that comes with severe consequences. Washington's interest expenses have quietly overtaken defense spending. They've overtaken health spending. And at the current pace, by 2030 the US will spend more on interest than on Social Security. Think about that. Americans will be paying more to service old debt than to take care of retirees, hospitals, or the military. The entire country becomes a debtor nation, a place where tax revenues don't build bridges, don't fund schools, they simply go to pay back bondholders. A nation of debt servants. So, what about a default? A debt jubilee? Write everything off? Tempting idea. Impossible reality. Wall Street would revolt. China and Japan, massive US bondholders, would go nuclear financially. And the US Treasury market, the foundation of global finance, would shatter for generations. No one would ever lend to Washington again. Ever. So that option is gone. And that leaves only one weapon left. Slash interest rates. Hard. Fast. No matter the cost. Interest payments are now over $1 trillion per year. That's half of next year's deficit, just in interest. Treasury Secretary Scott Bessent is already shifting America's borrowing almost entirely into short-term bonds because they're easier to push down with rate cuts. This is coordinated. This is deliberate. This is the endgame. To make this work, Trump needs the Federal Reserve to obey, so he's populating it with loyal doves people who will slash rates regardless of inflation, regardless of consequences. The moment Steven Mnuchin became a Fed governor, it was checkmate. And Trump's favorite for the Fed chair, Kevin Hassett, the most aggressive dove in the entire administration. This is not subtle. This is not hidden. This is the plan. Flood the world with short-term treasuries. Crush short-term interest rates to 1%, maybe even lower. Refinance the entire US government at the bottom of the yield curve. It's a massive gamble, and it carries enormous risks. Here's the danger nobody in Washington wants to talk about. Short-term bonds mature constantly, meaning the government must refinance its debt every few weeks. If investors suddenly lose confidence even a little, they may not roll over their treasuries. Then what? The Treasury needs cash. The Fed steps in, and the Fed starts buying short-term bills directly, a textbook money-printing operation. This is the path to a confidence crisis. And ironically, by shifting the entire US debt structure towards short maturities, the government is making that crisis more likely. Because if investors don't trust the US for 3 months, why would they lock in money for 10 years? They won't. They'd be insane to. So long-term rates may not fall at all, even with the Fed slamming short-term rates to zero, and that's the nightmare scenario. But the administration has a trick. Deny inflation exists. If inflation doesn't exist, you can justify cutting rates to the floor. But here's the reality. Prices are rising. Coffee, bananas, bacon, all climbing. Tariffs have pushed prices up across the board. Consumer inflation sits around 3%, and it will not stay there. Wholesale inflation, 2.7%. Retail spending, down when adjusted for prices. Consumer confidence, falling fast. Americans are treading water. Barely. And when rates drop in 2026, a second inflation wave becomes almost guaranteed. But this time, the Fed might not raise rates, because raising rates would detonate the federal budget. All the Fed needs to do is quietly revise the inflation target to 3% or higher, and suddenly, rising prices become acceptable, normal, the new baseline. That sets the stage for 1970s-style inflation, without the political will to fight it. Now, for the breaking updates. The Fed just injected $13 billion into the banking system, the biggest liquidity boost since 2020. Why? Because the system is starved for cash. AI investments are burning through capital. Treasury issuance is exploding. Banks need liquidity, and fast. But the bigger bombshell, the Fed has ended quantitative tightening. QT was the only policy holding inflation in check. It was draining up to $100 billion per month from the system. And now, it's over. The Fed isn't selling treasuries anymore. They're sitting on their $6.5 trillion mountain of assets money that was supposed to be deleted from the economy, but never will be. That's an admission of defeat. QT was impossible. The economy needs permanent liquidity to survive, which means dollar debasement is back. There is one final pressure cooker building beneath the surface: money market funds. They hold over $8 trillion, all parked in short-term bonds, paying around 3.5%. When rates get slashed to 2%, then to 1%, the incentive to keep money parked there evaporates. This is the moment the tsunami hits Imai. Cash floods out of money markets and pours into Brian. One equities, gold, Bitcoin, the real estate, commodities, and even silver asset prices explode. Speculation reignites. The wealthy who already own assets get wealthier. The poor get crushed. The middle class gets hollowed out. The US already ranks among the top 10 most unequal countries on earth, worse than China, worse than India. And this next cycle will widen that gap even further. America is juggling too many crises at once. A trade war, a tech war, a manufacturing rebuild, a global military footprint, exploding deficits, political paralysis, and now, a Fed forced to choose between inflation and insolvency. There is no clean escape. The only survivable path is to inflate the pain away. A controlled fall, a managed erosion of purchasing power, a quiet devaluation of the dollar. Easy money is coming back. There's no stopping it. The train has left the station. So, here's the question. Does the Fed crush rates in 2026? How far does the dollar fall? And are we heading into a new era of permanent inflation? Let me know what you think in the comments. Stay safe out there, and if you found this breakdown valuable, smash the like button and subscribe, because we're going to navigate these crazy times together.